Hey everyone, welcome to Finance Mythbusters, part of our Wealth Matters channel. Don't forget to like and subscribe. And today we're taking on some of the biggest and most ridiculous finance myths that people still believe. If you've ever thought you could get rich by eating ramen noodles or make millions by trading stocks with no experience, you might want to keep watching, because we're going to break down the truth behind these and more. Let's get started. Alright, myth number 1. Eating ramen noodles makes you rich. Now, if you've spent any time on the internet or watching frugal living videos, you've probably heard this one. The idea is that if you cut back on small daily expenses, like eating cheap meals, you'll be able to save so much money that you'll eventually become a millionaire. Now let's clear this up. Eating ramen noodles every day will not make you rich. Sure, you might save a few bucks in the short term, but let's be real. Wealth is built through smart financial decisions, not just cutting out small expenses. The truth is, to build long-term wealth, you need to focus on things like boosting your income, investing, and living below your means, not just scraping by on cheap meals. Ramen noodles can save you a few bucks, but they're not going to turn you into the next Warren Buffett. To actually build wealth, you need to focus on increasing your earning potential, paying off high-interest debt, and, most importantly, investing. Next up, you can make millions from trading stocks with no experience. This myth has been fueled by social media influencers, app ads, and countless online success stories. I mean, who doesn't want to get rich quick, right? Here's the truth. While some people have made money quickly by trading stocks, they're the exception, not the rule. Stock trading is risky. It's not a magic way to get rich overnight. In fact, if you try to jump into stock trading without understanding how the market works, you're more likely to lose money than make it. Successful stock traders spend years learning about markets, analyzing companies, and understanding risk management. It's a skill. So if you're thinking about trading stocks to make millions without experience, just know it's not that easy. Instead, a better approach is to invest for the long term, with a diversified portfolio, and allow your money to grow over time. Here's a big myth. You need a lot of money to start investing. This is one I hear a lot, especially from people who feel like they're just not ready to start building wealth because they don't have thousands of dollars to throw into the stock market. But guess what? You don't need a lot of money to start investing. With the rise of fractional shares and micro-investing apps, you can get started with as little as $5 or $10. And that's the beauty of investing today. You don't need to be rich to begin building your wealth, so don't let a small balance in your bank account hold you back. Start small, stay consistent, and let compound interest work its magic. Even if you can only invest $20 a month, that's a great start. Alright, let's address a big one. Debt is always bad. This is a common belief that gets thrown around a lot, especially in personal finance circles. People hear debt, and immediately think it's the worst thing ever. But here's the thing, not all debt is bad. In fact, there's something called good debt. Good debt is when you borrow money to make an investment that will grow in value, like student loans for your education, a mortgage for a home, or a business loan to start or grow a business. On the flip side, bad debt, like credit card debt, payday loans, or car loans for a car that's rapidly losing value, can hold you back. The key is to differentiate between good debt and bad debt, and use debt strategically to build your future, not to get stuck in a cycle of payments that don't help you grow financially. Another myth we need to bust: you should always pay off debt as quickly as possible. Now, paying off high-interest debt is definitely important, but here's the kicker. Sometimes it might make more sense to invest instead. Let's say you have a low-interest mortgage, but the stock market is delivering returns of 7 to 8% per year. If your mortgage rate is only 3%, it could make sense to invest in the stock market instead of paying off the mortgage early. Why? Because your investments could potentially earn more than what you're paying in interest on the mortgage. Balance is key. You want to prioritize paying off high-interest debt, like credit cards. But you also want to make sure your money is working for you by investing, especially if you can earn more from investments than what you're paying in interest. Here's another popular myth. You can retire early with just a 9-to-5 job. I know we all dream of the beachside lifestyle, but the reality is that retiring early is not easy, especially if you're relying solely on your 9-to-5 salary. To retire early, you'll need to save aggressively, invest wisely, and probably increase your income through side hustles or even creating passive income streams. It's about more than just putting money into a retirement account. It's about making your money work for you in every way possible. Getting to early retirement is achievable, but it requires careful planning, budgeting, and financial discipline. So don't expect to retire in your 30s or 40s just by sticking to a regular paycheck. You need to think outside the box. So, there you have it. We've busted 6 of the most common finance myths. The bottom line, building wealth takes time, smart decisions, and some work. There's no secret formula, no magic trick, but with the right knowledge and mindset, anyone can improve their financial situation. Make sure to hit that subscribe button for more myth-busting episodes and drop a comment if you've ever fallen for any of these myths, or if you've got a financial myth you'd like me to debunk in a future video. Thanks for watching, and I'll see you in the next one.